So come to this problem. For the purpose of valuation, fixed assets and current assets are to be depreciated by 10%. I mean, they have given calculate the value per share. Details have given. For the purpose of valuation, fixed assets and current assets to be depreciated by 10%. Interest on debenture is due for 6 months. Preference share dividend is due for 1 year. Neither of these has been provided so far. Calculate the value of each equity share under net asset method. Asset method, net asset method, nothing but some people say intrinsic value method, some people say book value method. Anyway, so asset method, net assets method. Market value of all assets. Market value of all assets. So we'll take fixed assets. Fixed assets. 4 lakh, they said to be depreciated by 10%. So 4 lakh depreciated by 10% means I'll take remaining 90% because 10% subtracted, 90% remains, that is 3,60,000. Current assets, we have 3 lakh. This also to be depreciated by 10% means remaining is 90%, which is 2,70,000. So current assets done, fixed assets done. That's all asset side. Liabilities now. Market value of liabilities. We have to subtract. We don't have any other assets. I mean any other market value. We have current liabilities, which is 1 lakh. Subtract as it is. We have debentures. 1 lakh. So tell me how much net assets comes to. 3,60,000 plus 2,70,000 minus 1 lakh minus 1 lakh. And they also said one more thing. Oh, preferential capital is also there because we are computing value per equity share, value of equity share. So we have to subtract preference share capital also. Subtract preference share capital 1 lakh. And not only preference share capital, they also said interest is due for 6 months. Interest on debentures due for 6 months. Preference share dividend is due for the year. So both we have to subtract. Minus interest on preference interest on debenture for 6 months, which is 1 lakh. Debenture interest is 6% for 6 months. That comes to 3,000. And we should also subtract preference share dividend. So minus preference share dividend. Preference share dividend is of 5%. So 1 lakh into 5%, 5,000. The net amount comes to 3,22,000. This is the net assets. Per share basis, divide by number of shares. Number of shares, they said equity shares of 100 each, 2 lakh. 2 lakh by 2,000 means 2 lakh by 100 means 2,000. So divided by 2,000. 3,22,000 divided by 2,000, you get 161 rupee per share. 161 rupee per share. Okay, this what is asset method. I don't think this can come in exam. I just did it only for part of syllabus purpose. I don't think these things can come in exam. Very simple, very straightforward. Okay, I hope it is done. I'll move further. Okay, so come to this problem. Come to this problem. The capital structure of Sun Limited. Please come to that. Okay, let's read. Capital structure of Sun Limited on 31st March 2003 was as under: equity share capital, preference share capital, debentures, reserves. Sun Limited earns a profit of 32 lakhs annually on an average before deduction of income tax, which works out to 35% and interest on debentures. Normal return on equity shares of the company similarly placed is 9.6%, provided profit after tax covers interest and dividends at least 3 times. Capital gearing ratio 0.75. Yield on the share is calculated at 50% of distributed and 5% on undistributed profits. Sun Limited has been regularly paying equity dividend of 8%. Compute the value per equity share of the company. Analyze the value per equity share of the company assuming the risk premium as 1% for one time of difference of interest and fixed interest coverage, 2% for every one time of difference for capital gearing ratio. So this is premium method or yield method. So what do we do? Okay, let's first calculate earnings. They said Sun Limited earnings profit of 32 lakhs on an average before reduction of income tax. So we have to compute first what is profit after all adjustments. Okay, so, and they said it is before debenture interest also. So let's start from first let's calculate profit after tax, then we'll come to all these ratio calculations and valuation. Okay, first we'll calculate the profit after tax. They have given, they said earnings before interest as well as before tax 32 lakh. We subtract interest and we have debentures information available. Debentures 64 lakhs and interest on that is 12%. So 64 into 12%, 7 lakh 68,000. Subtract, you get profit before tax. Then subtract tax, they say 35%, you get profit after tax. Subtract preference share dividend, that will give you 40 lakh into 8%, 3 lakh 20,000. So this is the preference share dividend. Regarding equity dividend, what they told, equity dividend is to be given at what share? Sun Limited has been regularly paying equity dividend of 8%. 8% of what? 8% of equity share capital. So 8% of 80 lakh, that is 6 lakh 40,000. So retained earnings is 6 lakh 20,800. This is undistributed profits. And this 6 lakh 40,000 paid to equity shareholder is distributed profit. Don't take preference share dividend, that is not the amount paid to equity shareholder. So from the equity shareholders point of view, distribute profit is 6,40,000, undistributed profit is 6,20,000 to 800. Anyway, write down till here, then we'll come to the ratio calculation. First you write down till here. Okay, let's go further. They said two ratios are given. So from this problem point of view, investor looking at these ratios. If the ratios are good, they say it is in line with the expectations. If the ratios are bad, some kind of risk is there. So when risk is there, we should expect more return. For that information is also available in the problem. So interest and dividend coverage ratio. So whenever we say interest coverage ratio, it should always be before that. So if it is interest coverage, it should be before interest. If it is dividend coverage, it should be before dividend. That is the amount which need to cover something. Correct? So here in the numerator, it's the profit before such elements. So profit after tax, which is definitely before preferential dividend. So no need to add back that, but it is after subtracting debenture interest. So, but when we say coverage ratio, it has to cover something, right? Now cover something means before that, but interest is already subtracted. We need before interest, so add back. So profit after tax plus debenture interest. I need not do plus preferential dividend because preferential dividend is yet to be subtracted. So no need to add back that. Can we take EBITDA? Some people say you can, but here they said profit after tax. Question only specifically said, right? Question said profit after tax covers. So you can't take EBITDA there. We need after tax. We need to take after tax we need to take after tax only. We can't take before tax. If they've not specified like this, had they just say profit covers, you could have taken EBIT for ratio for this coverage ratio calculation purpose. Okay, so profit after tax divided by debenture interest plus preferential dividend. So profit after tax 15 lakh 8,800, then debenture interest 7 lakh 68,000 divided by debenture interest same 7 lakh 68 plus preferential dividend 3 lakh 20,000, which comes to 2.16. Write down this, then we compute the another ratio. Write down this. Okay. Okay. Now, 2.16 is the coverage ratio. What does question says? It should be at least 3 times. At least 3 times. But what we are at 2.16. Now, are we meeting the criteria? No. Are we short of criteria? Definitely yes. We are fall short of 3. I mean, it was supposed to be 3, but we are having only 2.16. So, what is the risk we are taking? How much more we have to expect? For that, information is given. They said 1% for every one time difference between for interest and fixed dividend coverage. Meaning, 3 was supposed to be covered, and we are having only 2.16. So what is the difference? We are short by 0.84. They said 1% for one time difference. We are difference of 0.84 times. So for one time ratio 1%, 4.84 times 0.84%. So the risk premium to be considered is 0.84%. They said one time for 1%, we are 0.84 times, therefore 0.84%. 0.84 times is the difference. 0.84 times is the difference. Okay. Next, capital gearing ratio. Capital gearing ratio is basically we take preference share capital also as debt, but is nothing but fixed interest bearing fund, fixed income, fixed expense bearing funds. So numerator we will have debenture as well as preference share capital. Debt to equity ratio only changes. Preference share capital also considered as debt because you have a fixed income, a fixed outflow of dividend. So numerator preference share capital plus debentures, denominator equity share capital plus reserves. I'm getting one question. What about tax saving on debenture interest? We will not add back, because if you add back, that means you completely ignore debenture itself. We are not ignoring debenture. We are just adding back debenture interest so that it is the profit before considering debenture interest. But debenture interest tax benefit is already considered. When we compute the profit tax at 35% tax rate, it is computed on debenture also. That debenture impact is also considered. So tax saving is already considered. If you add back, what will happen? The tax saving will be removed. We don't want that to be removed. That should be there with us because debenture interest is with us. So debenture interest tax benefit should also be with us, but only for the purpose of calculating this ratio we are adding debenture interest back. Does not mean we are removing debenture. Unlike your EPS calculation and all, we are not removing debentures. Debenture interest tax benefit should be considered, and it's already considered. And if you add back, that will be eliminated. That should not happen in this case. Okay, so preference share capital is 40 lakh, debenture 64 lakh, equity share capital 80 lakh, reserves they have given 32 lakh. So ratio is 0.93. But what they have given, it is supposed to be 0.75, but you have 0.93. That means you have a higher ratio. You should not cross, because higher means higher, this ratio means higher the debt, higher the loan, higher the obligation. We don't want that. So what is the premium? They said 2% for every one time. We are different by 0.75 and 0.93. Difference is 0.18. So 0.18 into 2%, that is 0.36%. For one time it's 2%. We are only 0.18 times, so 0.36%. So 0.84% risk premium because of non-fulfilling coverage ratio. 0.36% is the risk premium because of non-fulfilling capital gearing. Fine. Okay. Now, retained earnings, we assume it is including all the reserves, it including all the profits. Retained earnings assumed to be part of reserves and surplus. They have not told retained earning at the beginning of the year or reserves at the beginning of the year. Okay. Hope you have taken down. Okay. Let's go forward. Okay. Risk premium once more for capital gearing ratio. It was not supposed to cross 0.75%, but you have crossed 2.93 times. So, what is the difference? What is the excess? 0.75 to 0.93 means 0.18 times you have exceeded. And risk premium given in the problem, for one time it is 2%. You have exceeded 0.18 times. So, 0.18 times into 2%, that is 0.36%. One time it's 2%, 0.18 times it is 0.36%. Okay, I hope everybody is done with this. Now let's calculate the yield on shares. They only say 50% of distributed profits is the yield and 5% on undistributed profits. So 50% on distributed profits, that is dividend paid, 6 lakh 40, 50%, 3 lakh 20. 5% on distributed profits, so 6 lakh 2800 is retained earnings. 5% means 31,040. Total yield on equity share as per their calculation, 3 lakh 51,040. So you can compute the yield directly based on this, based on required rate of return. You can calculate the value, or you can compute one formula like this. I'll show you both the methods because sometimes they show the solution like this, so to understand. So let's calculate the yield as a percentage on share capital. Later, I will apply return on face value, so both will match. So yield on share is 3,51,040 and share capital is 80 lakh. 3,51,040 is the return on a capital employed. Pure equity capital is 80 lakh. So return or yield is 4.39% on equity capital face value. Write down till here. Okay. Okay. Next. So what we got the return now is on face value, on capital, paid up capital. But what is the return expected? Normal return expected is 9.6. But we are expecting more because of ratio not fulfilling the expectations. For dividend coverage, we computed the 0.84 interest dividend coverage. For capital gearing ratio, we compute 0.36. The required rate of return is 10.8%. The value of equity share is calculated by with this formula. I'll tell you how to calculate without this formula also, but as of now you calculate with this formula. That is actual yield by expected yield multiplied by paid up value. The concept is this: on the paid up value, face value per share, 100 rupees multiplied by its actual yield. So 4.39%. On 100 rupees, you expect 4.39% return. So what is the income? 100 into 4.39 divided by expected return, like the perpetual cash flow formula: income divided by rate of return, cash flow divided by rate of return. So paid up value into actual yield gave you the income per share basis, divided by expected rate of return is nothing but the perpetual cash flow formula. You get the value per share. So paid up value multiplied by the actual yield divided by the expected yield. This is a formula they say, but you can do without formula also, I'll tell you. But as of now, just compute this much. From where we get normal return expected? Are you asking in this problem, or how do we get in real life? In this problem, you get it in the problem. You have to read the question, my dear friend. Okay. Now, you can also calculate this in one more manner. Let me tell you that also. Uh, so, yield on equity share we got, instead of calculating this percentage basis method, we can calculate it on value of the company itself. In the sense, we got 3,51,040. This is the yield. Your required rate of return is how much? As per this one, 10.8%. So calculate 3,51,040 is the yield divided by, like perpetual cash flow, divided by 10.8%. How much you get? 3,51,040 divided by 8%. So you get 43,88,000, right? This is the value of company as a whole, total value of equity. Then divide by number of shares, number of equity shares. How much is number of equity shares? Number of equity shares 80 lakh, face value is 100. So 80 lakh by 100 is 80,000. Divide by 80,000. 43 lakh 88,000 divided by 80,000. Different number. Okay, it's but oh, 32 lakh 50,000, is it? 3 lakh 51,040 divided by 10.8%. Oh, sorry, different number. This is not 43 lakh. This is 32 lakh 50,000 370. 32 lakh 50,000 370. Okay, divide by 80,000. Get 40.6 something. 40.6 something. You get the same answer, some difference in rounding off. So you can also calculate like this. That's also fine. But many times the institute gives you this method solution, so you can calculate during this method also. So whichever is comfortable, you can follow it. Exam point of view, both are accepted, but some of you looking at the institute solutions may be wondering. So I just did exactly from the institute solution point of this one. Okay, hope it is done. Okay, let me go further then. Okay, so come to this problem. Exxon Limited reported a profit of 100.32 lakhs after 34% tax for the financial year 15-16. Profit after tax is given. Analysis of the accounts revealed that income included extraordinary items of 14 lakhs and extraordinary loss of 5 lakhs. The existing operations, except for the extraordinary items, are expected to continue in future. Further, a new product is launched and the expectations are as under. So this is a new product. Existing income has given you profit after tax, and there is a new business which is giving you sales, material cost, labor cost, fixed cost. The company has 50 lakh equity shares of 10 each and 80,000 9% preference shares of 100 each, with P ratio being 6 times. You are required to compute the value of business, assume cost of capital to be 12% after tax, and determine the market price per equity share. So what and all they have given to calculate the value of business? We have given the income, but it includes some extraordinary income and expense which are obviously need to be eliminated because they are not going to come in future, and cost of capital to be 12%, required rate of return. So we have to follow the earnings capitalization method here, because we know the earnings, we know the expected rate of return. So earnings divided by the cost of capital, like a perpetual cash flow formula, will give you the value of business. Okay, let's compute that value of business using earning capitalization. Value of business using earnings capitalization. Okay, let's start from what we have. Report profit, given profit after tax. Profit after tax 100.32. But we need before tax for all the adjustments, because some income and all is there, expense and all to be eliminated, extraordinary items, to add back tax. Okay, can any of you calculate how much is the tax amount to be added? Tax rate, they said 34%. Now please don't do 34% on 100.32. This is after tax. So if I take profit before tax as 100, tax is 34, and profit after tax becomes 66. So 66 represents 100.32. 34 means how much? Cross multiply. 100.32 is representing 66. How much for 34? 51.68. Or directly you can multiply it by 100 also. So profit before tax 152. PBT, profit before tax 150. Profit before tax 150. Then we have to do two things, that is eliminate extraordinary items and then consider income from new business. Okay, now eliminate extraordinary items. Extraordinary income are 15 lakhs to be added or to be subtracted. Extraordinary income is already added, that will not come in future, that should be subtracted. So less extraordinary income add extraordinary loss, because loss is already subtracted, that loss is not repeated in future, that need to be added back. So income 14 lakhs to be subtracted, and loss 5 lakh to be added. Okay, now income from new business. New business is having sales of 70, sales 70, let me write in inner column, material cost 20, material cost 20, let's subtract labor 16, Fixed cost 10. So what is the income from new business? 70 minus 20 minus 60 minus 10, 30, 46. I think 24 you get. 24 profit. So what is the net income now? 150 minus 14 plus 5 plus 24. How much you get? 180 something I think you get. 167. 152 minus 14 plus 5. Okay, 167 you get. Fine. 167. 160. This is profit before tax. So we'll say future maintainable profits. Future maintainable or future profit before tax. Some people say future maintainable profits, but we need after tax. So minus tax. No change in tax rate, so we can take 34% itself. Sometimes future rate tax rate can be different. So 167, 34%. 56.78. So profit after tax. $110.22. And value of business, earnings capitalization methods. 110.22 divided by cost of capital. Cost of capital is 12%. Divide by 12%. 918.5. Value of business. Value of business. Income by cost of capital. Expected rate of return. Okay. First line red pen, just the heading. Value of business unit, earning capitalization. Just the heading. Okay. So first part of the question is done. Compute the value of business done. Now let's go for determination of market price. Computation of market price per share. For market price per share, what information shall we make use of? We will not use this cost of capital information because they have given the information in the past. Company had P ratio of 6 times. Let's estimate what is the EPS of a company and multiplied by P ratio, you'll be able to get the market price. So, what they've given, price per share, profit after tax we have calculated, PAT, profit after tax, 110.22. Profit after tax, revised, calculated, profit after tax, revised, 110.22. Minus preference share dividend. Before you divide by number of shares, do preference share dividend minus preference share dividend. Preference share dividend is given to be, oh, we don't have any preference share dividend. Oh, we have preference shares of 100 each. 80,000 preference shares of 100 each, 9%. So 80,000, 100 each, 9%. How much that comes to? 80,000, 100 each, 9%. 7,20,000, 7.2 lakhs, 7.2 lakh. So earnings available to equity shareholders. $103.2 divided by number of equity shares. Number of equity shares we have 50,000, 50 lakhs. So EPS, expected EPS 2.0604 multiplied by P ratio. P ratio, they said 6 times the expected market price. Oh, 103.02 is it? Okay. 03.02. Okay, divide by 50. 2.0604 only into 6, 12.36. Multiplied by number of shares, you get market value also, but they've asked only so much. Let's calculate only up to that point. Why preference share dividend is not considered while calculating value of business? Because value of business is from total investor point of view. We don't differentiate between debentures, equity shareholders, and preference shareholders. Value of business, I told you, value of entity, enterprise value. Value of business is not only from equity shareholder point of view, it's from entire investor point of view. But when I say market price per share, it's only from equity shareholders point of view. So all other things should be subtracted. So even debenture interest we will not be subtracting. If you say value of business, value of firm, even debenture interest will not be subtracted. Value of business is from investor point of view. It's like enterprise value. Loan is not taken into consideration. Preference share dividend is also not taken into consideration. Value of business, pure operating profit is considered. Debenture interest, preference share dividend and all is not considered. For value of business, for value of firm, for enterprise value. That's why you see the ratio for EV to EBITDA. What ratio we considered? EV to EBITDA is the ratio we considered. So operating profit is considered. Even interest is not subtracted. Okay, I hope it is done. Okay, so let's do the next one. Come to this problem. Data below is the extract of financials of a company for the year ended 31st March 2019. Compute EV to EBITDA ratio. We need enterprise value, we need EBITDA, we compute the ratio between the two. They have given the P&L account, they have given the balance sheet, they have also given the market price. Let's calculate. First, let's go for EBITDA, earnings before interest, tax, depreciation, and amortization. So we want before interest, but what we have in the P&L account, if you look at it, we have profit before exceptionals and extraordinary items, but we want not only profit before tax, we want profit before interest, depreciation, and amortization. uh, I'm getting one question. We are not getting a majority. Please slow down. Can you please tell me, are we doing any complicated problems here? It a simple computation of EPS calculation, profit calculation, tax calculation. That's all, right? We are not doing any formula applications also. I don't know what is the issue. And you are CA finance students. You have to be up to a certain level. If you are not up to that level, then you will not become a CA as straightforward as that. You have to increase your speed. And let me tell you, my dear friends, how do you learn speed? By practicing it, not making others slow down, right? If I can slow down, yes, I can slow down, but you will not improve your speed. That's why many people tell 6 months is not sufficient for exams. In the exam, not able to complete the paper. Why? Because nobody in the class force you to go at that speed. You're always in comfortable time. You have to move out of your comfort zone. You have to be at the speed what is required by the institute. Whichever area which you are not able to understand, you have to ask and get it clarified. This is the regular speed which you have to be with if you want to cover every subject on time as per institute standards. If you take time to understand, that's fine, but you cannot ask everybody to slow down. That is not right. Anyway, in my opinion, this is the speed required not only to cover the syllabus, but for you to be in line at a professional level. Okay, let's come to this. So we need profit before interest and before depreciation, but this profit is after interest. We don't have interest, we only have finance cost. Let's take finance cost as interest cost substitution. So this is after considering finance cost and after considering depreciation and amortization. We need before that. They have already considered it. We need to eliminate it. And how do we eliminate? We eliminate by adding back. So for this amount, we add back the interest cost, which is finance cost 10 lakh, and depreciation 5 lakh. That will give you the amount of EBITDA. So depreciation is added, finance cost is added, so you get EBITDA. So write down this EBITDA, then we compute enterprise value. Okay. Okay. So now we have done with the EBITDA, earnings before interest, depreciation and amortization. Now we'll calculate the other one, which is enterprise value. Enterprise value, I told you, is nothing but value of business, where we consider the value of equity as well as value of debt, market value minded, and we subtract cash because we want net debt. Any preferences also you would have considered. For market value of equity, market price per share given in the problem 250 multiplied by number of shares, number of equity shares 30,000, 75 lakh. Debt 50 lakh. How it is available? Let me just show it to you in the question. Share capital 30,000 multiplied by 250. Equity is taken care. Now when it comes to debt, we will consider total debt, that is borrowings 21 lakh 40,000, trade payables 10 lakh 20,000, provisions 18 lakh 40,000. So add all, how much you get? I think you are getting 50 lakhs. 21 lakh 40,000 plus 10 lakh 20,000 plus 18 lakh 40,000. Hope you are getting 50 lakhs. Why provisions? Provisions also is loan, right? Provision for tax. It's also a debt. It's also an amount to be paid. We are taking short term, long term, all debt to compute enterprise value. All liabilities taken, correct. All liabilities taken. And also the reason comparative what we take is EBITDA even before interest, right? So in the sense all the liabilities are added back. Anyway, that you don't worry, all liabilities are added. Okay. So we get 50 lakh debt. That's all. Cash you have to subtract, yes, because we need net debt. So cash we subtract. So what we get is enterprise value. Debt is all liabilities for the purpose of this ratio calculation. Of course, you can argue we don't take current debt, we take only long-term debt. Different points of opinion exist, but in general, we take all debt because we don't have rules. We don't have section numbers. We don't have provisos. We only have concepts to be applied. So different arguments will vary differently, but in general, you can say all debt to be considered for computing enterprise value. So market cap plus debt minus cash, enterprise value. Then the ratio between these two, EV to EBITDA, 1 crore 12 lakh 80,000 divided by EBITDA 19 lakh to get 5.4. Okay. Hope you have taken down till here. Okay. So come to this problem. Come to this problem. Using chop shop approach or breakup value approach, assign a value for Cranberry Limited, whose stock is currently trading at market price of 4 million euros. For Cranberry Limited, the accounting data set forth for three business segments: consumer, wholesale, retail, general centers. The data for the firm's three segments are as follows: business segment, wholesale, retail, general, segment sales, segment assets, segment operating income. Business segment, capitalization by sales, capitalization operating income, wholesale, retail, general. Okay. Chop shop approach, breakup value approach. Don't think about your breakup. Breakup value approach means we break it down. So when you consider a company, normally it will have one sector, one business. But company like Reliance, company like ITC, they have lot of segments, and each segment the risk is different, return is different. So what do? We divide the company's revenue, income, etc. into different segments, value the company as a segment independently, then we total it. Like in this problem, the company has three segments: wholesale, retail, general. So for wholesale business, retail business, general business, we compute the valuation separately. Then we can total it up. And one more layer also is there in this problem, which is we have so many ratios given. Capitalization to sales, using that method we can compute value of business. Capitalization to asset, using that method also we can compute the value of business. Capitalization by operating income, using that method also we can compute the value of business or value of segment. Now which one is the most appropriate one? Obviously we can't choose at this point in time. So as a student, what you're expected to do in exam: compute the value of business using capitalization, compute the value of business using capitalization of assets, compute the value of business using capitalization of operating income, then take an average. So all the basis, what ratio you have, compute the value of the segments, value of the business, then take a simple average maybe. That will be the value for the purpose of examination. In reality, of course, we can choose only one of them, or we can even add a layer of weighted average to give some ratios for importance. But we don't have to do that in exam because we don't have sufficient information to do that. So unless they give the weights, you don't worry about the weighted average and all. Just focus on simple average. So three segments are there. So segment valuation is one. That is one side. The other one, because we have multiple ratios, we compute on all ratios possible value of business, then we take the average. Okay. Could you please explain once again chop shop approach? So a generic question like this, I cannot answer it from the beginning once more. You have to ask specific questions. A general question I cannot answer. Just explain once more, where do I start? Then what is the meaning for the things I've explained so far? Should I repeat from the beginning once more? Please be specific in the question. What is pure play firm? Okay, be specific like this. Pure play firm means if the company was into only business, a company is into only wholesale business, a company is into only retail business, a company into only general business, then these are the ratios applicable for those companies. Pure play firms means a company with single sector. Ratios are given. Chop shop means dividing, breakup value. I told you, no, dividing the company into different sectors and value the sectors separately, then value the company as a whole. I gave you example of Reliance, I gave you example of ITC, because a company will have different sectors. Each sectors or segments are valued separately, then we total it up. Any other question still? Earlier, why we have taken market value of equity? Because when we say market price per share, it includes equity capital plus reserves, right? But preferential capital is a separate owners itself. Both equity share capital and reserves belongs to equity shareholders, which is considered in their market price. Okay. So we have three segments and we have three ratios. So as I told you, we'll compute one ratio at a time. So based on capital to sales, we compute the value of business. Based on capital to assets, we compute the value of business. Then based on capitalization to operating income, we compute the value of business. So based on three ratios, three bases, we get three values, and then we take a simple average to give you one number. So let's first focus on capitalization by sales. Now, using this ratio, we compute the value of wholesale segment, value of retail segment, value of general business segment. Let's consider one at a time. 0.85. What do you mean by capitalization to sales? Capitalization divided by sales is given to be 0.85 divided by 1. Denominator always means 1. So if 1 rupee is sales, capital means value, what we calculate. I told you earning capitalization. Here when we use the word capital, please don't ask the question, is it share capital, is it preference share capital, or is it capital employed or equity share capital. Here in this context, capital means value. So for every 1 rupee sales, capital value is 0.85 capitalization to sales. Now, in this case, sales is 2,25,000. So, how much is going to be the capital then? 2,25,000 capital to sale is like price to earnings ratio, like that we have. So, capital to sales 0.85 is to 1. If sales is 2,25,000, denominator 2,25,000, what is going to be the capital? Or you can also write like this for easy calculation, capitalization to sales. So 0.85 is to 1. Sales is 2,25,000. How much is capital? We can simply do it by 2,25,000 into 0.85 divided by 1. In some problem, what happens? They don't give capitalization to sales. They give sales to capitalization, sales to assets to capitalization, operating income to capitalization. In that case, what do? Very simple. Don't multiply 0.85, divide by 0.85, or what you can do, take the reciprocals, you get into this approach only. So for us, what we require is, we want a ratio which is like price to earnings ratio, price to sales ratio. In the sense, the price should come first. Like in this case, capitalization is coming first, which is completely fine. Just look at the earlier problem, the previous problem. Look at the previous problem, just for approach, previous problem. You see sales by capitalization is there, asset by capitalization is there, operating income by capitalization is there. So capitalization is coming second. We want come to first. So if they give you sales by capitalization, what do? You take a reciprocal of that. I hope you are clear on that matters. Okay, so let us calculate one by one. One second. Okay. Okay. So let's calculate valuation based on uh, I don't know how to give the right to speak option specifically. I'll speak to the technical person today. From tomorrow onwards, I'll enable that. As of now, I'm not very clear how to do it. I'll speak to the technical person today. From tomorrow onwards, I'll do that for you. Okay. So valuation based on capitalization to sales. Okay. The ratio is capitalization to sales. So it is multiplied. Just remember this point. If just multiplied like a price to a P ratio, like price to earnings. If sales to capitalization is given, if sales to capitalization is given, then take reciprocal. This is just for your reference. uh, Given capitalization to sales, it is multiplied like price to earnings. If sales to capitalization is given, then take the reciprocal. Okay. Okay. Now let's come to the numbers. Segment one by one. Let me just write in the columnar format. Segment wholesale, retail, general. Okay. So what they have given sales, let us write down. Segment sales 2,25,000, 7,20,000, 25 lakh. Ratio sales to capitalization to sales. Ratio given 0.85. So what is the value of segment? 2,25,000 into 0.85 equals to. As I told you, if they are given sales to capitalization, take the reciprocal first. Then you can easily multiply. So 2,25,000 into 0.85, you get 1,91,250. This is the value of wholesale segment based on, say, capitalization to sales ratio. It's like price to sales only. Capitalization means what? Price only. So price to sales ratio. This is like price to sales ratio. Retail segment ratio is 1.2. 7,20,000 into 1.2. 8,64,000. General ratio is 0.8. So 2 lakh to 25 lakh into 0.8, 20 lakh. So value of wholesale segment we calculated, value of retail segment we calculated, value of general segment we calculated. But this company has got all the three segments. So what is the value of the business then? Value of company as a whole. Value of company as a whole is sum of all these three. 1,91,250, 8,64 plus 20 lakh. That is 30,55,250. Where is 0.36 coming from? I'm not sure. What is 0.36? Okay, then valuation based on capitalization to sales we have done. Next, we have capitalization to assets. So, valuation based on capitalization to assets. Same approach we do, in the sense we will write segment. We don't write sales, we write the assets, then capitalization to assets. Then the value of segment. Okay, three segments: wholesale, retail, and general. Assets we have 6 lakh, 5 lakh, 40 lakh. 6 lakh, 5 lakh, 40 lakh. Now, ratio given 0.7, 0.7, 0.7, that is same for all. Multiply 6 lakh into 0.7, 4 lakh 20,000, 5 lakh into 0.7, 3 lakh 50, 3 lakh 50,000, lakh 50,000, 40 lakh into 0.7, 28 lakh. The total 35 lakh 70,000. So value of company using capital to sales we have done. Value of company using capitalization to assets we have done. Now another alternative, because one more ratio is available. Valuation based on capitalization to operating income, like EV to EBITDA kind of thing. Capitalization to operating income. Three segments again. Wholesale, retail, general. So we have operating income here as a numerator, as a heading. Then capitalization to operating income. Value of segment. Then the value of company, of course. Okay, so operating income they've given 75,000, 1 lakh 57 lakh. Capitalization factor given 984. So 75,000 into 9, 6 lakh 75,000. 15 lakh into 8, 12 lakh. 7 lakh into 4, 28 lakh. Total 46 lakh 75,000. Lakh 75,000. So valuation based on sales, we got one number. Valuation based on assets, we got one number. Valuation based on operating income, we got one number. Then we are going to do the average, because we can't add three of these. These are the numbers calculated based on three ratios. We can't add all of them. We can take only one of them. Some people take in lower, because person who want to buy the company will say I want to pay less. Person want to sell the company say I want to sell it at higher price. So negotiations will happen, bargaining will happen practically. But here let's take a average. Okay, so I'll take the first two lines out. Okay, so overall average, overall value of company based on simple average. Thirty lakh 55 250 plus 12 lakh, so plus 35 lakh 75,000, 5 lakh 70,000 plus 4675 whole divided by 3. That comes to 3766 750. So this is what is breakup value approach, where we compute the value of a company based on individual segments, because a company will have multiple sectors like ITC Reliance. Once we compute the segments individually, we use different ratios, or if we use different ratios, then we are going to take an average overall. This problem can also be worked out one more way, that wholesale segment based on three ratios you calculate, then you take the average. Retail segment based on three ratios you calculate, then take the average. General segment, you take compute based on 3 ratios, then take the average, then 3 numbers you can total it up. That also will give you same number mathematically. You can check out it later. Okay, so this is with respect to the chop shop approach method of valuation. I hope this is fine. I'll go further. Any doubts with respect to these calculations? Okay, very good. Let's go further. Come to the next problem. XY Limited, a cement manufacturing company, has hired you as a financial consultant of the company. Cement industry has been very stable for some time, and the cement companies SK and AS Limited are similar in size and have similar product market mix characteristic. Similar companies use comparable method to value of equity. In performing the analysis, use the following ratios: market to book value, market to replacement, market to sales, market to net income. The following data are available for your analysis: SK Limited, AS Limited, XY Limited. Market value, book value, replacement cost, sales, net income. So basically they are telling, using SK Limited and AS Limited, which are your competitors maybe, or in your similar business, compute the value of XY Limited. Don't think market value here blank, it's a printing mistake. No, it's not a printing mistake. That market value only we should calculate. Fine. So comparable method means we compute the ratio of our competitors or company in that segment, in that industry. That ratio we apply to our company as well. Market to value. So SK Limited has got one ratio. AS Limited has got one ratio. Assume it both are same. We are in the same business. So their ratio should be applicable to our company as well. I know every company differs, but at least it should be very close because they are into some industry, because industry characteristics are similar. So their ratio we will apply to our company, and based on that we compute the value of our market value. Here we have two companies. Just give me 1 second. Now, basically what we are trying to do here is compute the industry average and overlay it on a company ratios. Now, industry here, we don't have many industry, we have only two companies in the industry. One is SK Limited, AS Limited. So we can take a simple average, thereby we get the industry average. So we'll do it on a columnar basis. Okay. Let me give the heading. Whatever the parameter name, then we have SK Limited as one company, AS Limited as one more company, then we take the average. In the sense, this reflects industry ratio. Only two companies are there, two companies average we take. Then whatever the XY Limited value we have, XY Limited parameters, and then we take the whatever the market value we calculate, XY Limited value. Okay, one by one. First parameter we have market to book value. market to book value. Okay. Now, name itself will tell you market to book value. So, market by book value for SK Limited, market is 450, book value is 400. So, 450 divided by 400. Similarly, AS Limited, 400 by 300. 400 divided by 300. So, 450 by 400. 1.125. 400 by 300. 1.33. You can take 2 decimals also. Since 125 I am taking, here I will take 3 decimals. So, average 1.125 plus 1.133 divided by 2. Point 125 plus 1.133 divided by 2, 1.129. That is market to book value, like capitalization to book value. And book value of SY Limited is 250. So, we will write 250. So, what is the value of XY Limited? 1.129 into 250. 282.25. Okay. I hope you are able to understand why we are multiplying. Simple concept. You know, price to earnings ratio. If earning is available, multiplied by price, we get the expected price. Multiplied by P ratio, we get the expected price. Price to sales ratio. We will have sales multiplied by price to sales ratio, we get the expected price. In the earlier problems we did, whenever it is capitalization first, you can simply multiply. And whenever it is sales first, earnings to capitalization and all, then we divide. Hope you understand when we multiply, when we divide. I understand how to correct it, but I'm explaining. I can't go beyond. When one person, okay, okay, anyway. 1.229, 250, 307.25. Okay, 07.2. Okay, next one we have market to replacement cost. Market to replacement cost. For SK Limited, replacement cost 600, 600 by 400. For AS Limited, it is 550, 550 by 400. So 600 by 400. 1.5, 550 by 400. Sorry, replacement cost 550, market value 400. 550 by 400. Market value 450. Sorry, 600 by 450. Yes, 600 by 450. 450 by 600. Sorry, 450 by 600. 450 by 600. 0.75. Market value 400, replacement cost 550. 400 by 550. 0.727. Average 0.75 plus 0.727 divided by 2. 0.7385. Parameter of XY Limited replacement cost 500. 500 into 0.7385, 369.2. Okay. Then market to sales. $450 by $550. $400 by $450. $450 by $550. 0.818. 400 by 450. 0.889. 0.818 plus 0.889 average 0.8535 multiplied by sales value of XY Limited 500. $426.75. Then net income to market to net income. One or two difference that depending on round off you take, you can take 2 decimals, 4 decimals. So that's depends on whatever you can take. That's fine. That's accepted. In valuation, I told you, you cannot get an exact 1 rupee without 2 rupee difference. You cannot get a value. It's not possible. We are not doing law. We are not doing income tax. Accurate answer don't get. Rounding off will always happen. So net income 18 by market value 450. Net income 18. 450 by 18. 400 by 16. 450 by 18. 25. 400 by 16. Also 25. 25 plus 25 divided by 2, get 25, multiplied by net income XY Limited 14. 5 into 14, get 3. Then based on 4 ratios we calculated 4 numbers, but we are computing one for one company only, so we'll take the average. Average for overall calculation. Like 4 ratios are there. So 307.25 plus 369.25 plus 426.75 plus 350 whole divided by 4 comes to 363.31. Okay, so this is one of the exam problems. Again, just to give an idea that the valuation is a very subjective element. Various ratios can be argued. All ratios may be correct. So try to do as many ratios as possible. We take an average. So we give justice to all possible variations. Of course, practically, uh, different people argue differently depending on what is comfortable to them. Okay, hope it is done. Simple one. Okay, so come to this problem. Following information given for QB Limited. Some 26th or 27th problem like that. Following information is given for QB Limited. Earnings per share 12, dividend per share 3, cost of capital 18%, internal rate of return on investment 22%, retention ratio 60%. Hope you got the question. Okay. Now, earnings per share shortcut formula, cost of capital is fine. Now, dividend per share, tell me, should we take D1 or should we take D0? Is it D1 or D0? They have just mentioned dividend per share. Yesterday I made you to write. Conceptually, in the examination also, either you can take D1 or you can take D0. But ICI always taken it as D1. So based on observation purpose, we will also take it as D1 for observation purpose to meet the institute solution. But for examination purpose, you can write D0 also, but make a note anyways. Whenever you make an assumption, make a note, but this is a recommended assumption. The cost of capital is KE, return on investment, internal rate of return investment, IRR, retention ratio, B. And if you're using, okay, Gordon's formula, let's use first. Gordon's formula. Gordon's model. Because we have D1 here, let's use P0 equals D1 by KE minus G. D1, we just identified is 3 rupees, sorry, 3 rupees divided by KE. Okay, what is KE here? Cost of capital 18%, 0.18. Minus, what is growth rate in this problem? Growth rate need to be calculated. Okay, let's calculate growth rates. B into R. Okay, what is retention ratio in this case? In this problem, how much is retention ratio? 60%. Okay, this is the slight trick or inconsistency, I don't know. Look at the problem. Their earnings per share is 12 rupees. Dividend per share is 3 rupees. That means they retained 9 rupees. And what is retention ratio formula? Retained earnings divided by EPS. So 9 rupees by 12 rupees, that means they will get 0.75 or 75%. So should I use 0.75 or should I use 60%? When we are taking dividend of 3 rupee per share, we have to take 0.75% as retention ratio. Now, if I use retention ratio of 60%, then dividend of 3 rupees should not be used. Dividend need to be calculated. So, which one is correct? If I use 3 rupees dividend, 0.75 to be used, but retention ratio 0.6 given. If I use zero point 0.6, dividend 3 rupee cannot be used. Dividend has to be recomputed. So this is a pure inconsistency in the question. Unfortunate. Can't help. So what does institute do in this case? They don't accept it is their mistake. What they do? Whichever way you calculate, you get this number, give him the marks. Institute accepts both the answer. But if you take 3 rupees dividend, 60% retention ratio, that they will not give marks. Because if 3 rupees used, retention ratio is 0.75. If retention ratio 0.6 is used, dividend 3 rupee cannot be used. So either use the recomputed dividend and retention ratio of 60%, or use dividend of 3 rupees and retention ratio of 0.75%. Both the alternative answers are accepted in exams, but not a crossbreed. You can't say 3 rupee dividend, 60% retention ratio. That is straight away not accepted. So we will also write down the alternative answers. So here retention ratio will be 0.75 as we calculate here. 0.75 into return on investment 22% is 0.2. So 0.75 into 0.22, what do we get? Point 165. 0.165 I can use 3 rupee by 0.015, 200 rupees. Or alternatively, same formula we use, T equals 0.6 into 0.75, or 0.22, sorry. If I use retention ratio of 60%, 0.6 into 0.22, 0.13. But in that case, I have to compute a different dividends. The dividend equals earnings per share is 12 rupees into 1 minus retention ratio. So 60% is retention, means 40% would have been paid. So 12 into 40% means 4. T0 equals D1, which is 4.8 divided by K minus G, 0.18 minus 0.13. Right? 100. The numbers correct? Please check the calculations. Okay, just give me 1 minute. One minute. Okay. Anyway, let's go further. Let's do the Walter model. Walter model is straightforward, not at all complicated. No alternatives like this. Let's write the formula. P0 equals EPS one part, EPS minus DPS another part, divided by RC into RA whole divided by RC. Okay. So we get DPS given as 3 rupees plus 12 minus 3 divided by RC, cost of capital 18%, return on assets 22%, whole divided by 0.1. 9 into 0.22 plus 2.22 plus divided by 0.18. 11. P plus 11 divided by 0.18 by 0.18, 77.78. Okay, 77.78. Okay, so this is the one problem. Come to this problem. CBZ company, maybe problem 4950, something like that. CBZ company. Hope you got it. CBZ belongs to a risk class for which approved capitalization rate is 10%. Capitalization rate means cost of equity, KE normally we say. It currently has outstanding 6,000 shares, selling at rupees 100. Selling at 100 means current price. Current price is P0. The firm is planning for declaration of dividend of 6 rupees per share at the end of the current financial year. Planning to recommend, planning to declare, meaning planning to pay. DPS. Dividend D1 you can say. D1 is also fine. At the end of the current financial year. The company expects to have a net income of 60,000 and has proposal to make new investments of 1,50,000. As under hypothesis, the payment of dividend does not affect the value of the firm. Calculate the price of the share at the end of the year, number of shares to be issued, and the value of the firm separately in the following situations: when the dividends are paid, when the dividends are not paid. So let's solve it in a columnar format. So when dividends are paid, when dividends are paid, second situation, dividends not paid. Okay. So first let's write down what is the income for the year. Income for the year, they have a proposal to have a net income of 60,000 minus dividends paid. Of course, they're planning to pay. They're not yet paid, planning to pay. How much they're planning to pay? 6 rupees per share. They're having 6,000 shares. 6 rupees into 6,000, 36,000. And dividend not paid means nothing, blank. So how much is retained earnings? 24,000 and 60,000. Now, what is the investment planned? Investments. They're planning to make an investment of 1,50,000. So now there is a shortfall. Now, how do you fulfill the shortfall? How do you get the money on the shortfall? It is raised by issue of shares. Amount raised by issue of shares. So how much shortage? 1,50,000 minus 24,000. 1,26,000. And here 190,000. Now you see, where because company pay more dividend in the first case, they have to issue more number of shares to get 1,26,000. In the second case, they did not pay dividend, they will issue less number of shares, only 90,000 amount required. Hope you are able to get it. Anyway, so this is amount raised by issue of shares. We require number of shares. For number of shares, we require the price, and this is not the number of shares to be issued today. This is the price or the shares to be issued after year 1. So let's calculate P1 using the formula. P1 equals D1, sorry, P0 equals D1 plus P1 divided by 1 plus KE. So here P0, that is price today 100, equals D1, dividend expected to be paid 6 rupees, plus P1 we don't know, we have to calculate, divided by 1 plus KE, cost of equity. How much is cost of equity? 10%, 0.1. Cross multiply 100 into 1.1 means 110. 6 rupees goes to left side, minus 6, that is equal to P1, or P1 equals 104. Similarly here, when dividend not paid, 100 equals, here it is 0 plus P1 by 1 plus 0.1, 100 into 1 plus 0.1, which is 110, minus 0 is P1, or P1 equals 110. Now, can you understand what is the difference between 104 and 110? What exactly is the differential amount? Which is 6 rupees. And what is that 6 rupees? That 6 rupees is nothing but dividend amount. So, you remember the concept I told you yesterday in the previous session? When the company pay dividend, share price will come down. You see, dividends are paid, so it is 6 rupees less. It is called as ex dividend price, all other things remaining constant. Anyway, so that's only observation. So P1 we got, P1 we got. Let's compute number of shares. Number of shares, new shares, additional shares, 1,26,000 divided by 104, 90,000 amount required divided by 110. One lakh 26,000 by 104, 1211.5. You can round it off. I'll just take decimals also, only for verification purpose. 1211.54. I take only these decimals. So when I want to verify the answer, I want to make sure that answer matches, the amount matches, only for that purpose. Otherwise, you can round it off. Small difference will come when you verify it. So 1211 and 90,000 by 110, 818.18. Okay. So now let's go for value of the firm. Value of firm today given by, I told you, N1 plus N2. New shares plus old shares multiplied by P1 plus income minus investment, whole divided by plus income minus investments whole divided by 1 plus K. So in the first case, N1 existing shares. How many shares was there existing? 6,000 shares. 6,000 plus 1211.54 multiplied by P1, price after year 1, 104, plus income minus investment. So plus 60,000 minus investment of 1,50,000 divided by 1 plus K divided by 1 plus cost of equity, which is 10%. How much you get? 1,000 plus 1211.54 into 104 plus 60,000 minus 1,50,000 divided by 1.1. You get 6 lakh approximately. Divided by 1.1. If I do when dividend is not paid, 1000 plus 818.18 into 110 plus 60,000 minus 1,50,000 divided by 1 plus 0.1000 plus 818.18 into 110 plus 50,000 minus 1,50,000 divided by 1.1. You get 6 lakhs. So you see whether dividend is paid or not paid, the value of the firm is same. So this M&A model, no more complication beyond this. This is the columnar format and these are steps you have to follow. Simple format. Only two formulas which are not so much complicated to be remembered and applied. And for verification purpose, easy to verify. Value of the firm today, easy to verify. How many shares are there? Today, 6,000. Today, what is the market price? 100. 6,000 into 100, you get 6 lakh. That's what is this amount is all about. Even price per share you can understand and remember conceptually. Look at what is share price today, 100 rupees. On that, required rate of return is 10%. So on 100 rupees, required rate of return is 10%, which means 10. So it will be 110. That's what this number 110. If dividend is paid, subtract 110 minus 6, which is 104. That number also you can get it. Anyway, you write down. Simple one. See if you have any doubts. Okay, let's go further. Okay. In exam also, can we take the fractional number of shares? You can take only for verification purpose. If you want to be more safer, you can give a note that only for the purpose of verifying the answer accurately, a fractional shares has been assumed. Or if you have not taken, that's also fine. You round it off and the final answer will have small difference and you write a conclusion telling that the difference in the value of the firm is due to rounding of number of shares. So like that also you can give the conclusion in exam. So both way it's accepted. Okay. So come to this problem. Z Limited is forcing the growth rate of 12% per annum In the next 2 years, growth rate is likely to fall to 10% for the third and fourth year. After that, growth rate is expected to stabilize at 8% per annum. In the last, if the last dividend paid was 1.5 per share and the investors required rate of return 16%, find out the intrinsic value per share. You may use the following table. Years, discounting rate. Okay, so let's first write down what and all is available. Growth rate of 12% for 2 years. So year 1, year 2, growth rate 12%. Then growth rate is likely to fall to 10% for third year, fourth year. So year 3, 10%. Year 4, also 10%. After that, growth rate is expected to stabilize at 8%. That means what? How many? Which year? This will be year 5 onward. Year 5 onwards, stabilize at 8%. Dot dot dot. So here we are having a different growth rate applicable for different number of years. Variable growth rate. Now, in case of variable growth rate, you remember I told you we follow multi-period dividend discount model. Do we apply Gordon model here? Yes, only after the growth rate become stabilized. So year 5 onwards, where the growth rate stabilized, here we can use Gordon model because the growth rate became constant, applicable for perpetuity. So let's write in our regular columnar format for more clarity purpose. Year cash flow discounting factor at the rate of 16% and discounted cash flow. So year 1, year 2, year 3, year 4, year 5 onwards. Now please tell me, year 5 onwards, what price you get? We don't use the term price, we use the term terminal value. Which terminal value do we get? Year 5 onwards means we get TP4 or P4. That's also fine. Let's calculate one by one. Now, they just told dividend last paid. Last dividend means just paid. So this is D0. Growth rate for first year 12%. So 1.5 into 1 plus 0.12 will come to 1.68. Now second year also 12% only. So 1.68, again 1 plus G, or you can do 1.5 plus 1.12 whole square, that's also fine. Second year also same growth rate, 1 plus 0.12. 1.8816, you can round it off, that is also fine. I'll just round it off, you can do directly. Now 1.88 into 1 plus third year growth rate 10%. 1.88 into 1.1. 2.068, let me round it off, 2.07. 2.07, again fourth year growth rate is 10%. 2.07 into 1.1, 2.277, okay, round it off, 2.28. And D4 means D5 by K minus G, and D5 is nothing but D4 into 1 plus G, 2.28 into 1 plus constant growth rate, this number 8%, 0.08 divided by K minus G 0.16 minus 0.0. Write the formula if you want for your reference purpose. T4 equals D4 into 1 plus G by K minus. The D4 into 1 plus G nothing but that is D5. So you get 0.28 into 1.08 divided by 0.0, 30.78. Okay, discounting factor at 16%. They have given, make use of it. Year 0 don't use. That's today value. That's I think small alignment issue here. Just the alignment. Yeah. Don't use year 0. Year 0 today value. Use from year 1 onwards. 0.86, 0.74, 0.64, 0.55. What is the discounting factor for the last one? Will you use 0.55 or will you use 0.48? You should use 0.55 only. Don't use 0.48. Just to confuse you, they have given. And institute is always very supportive. If you want to do a mistake, institute will help you do it. They are so supportive, so cooperative. Because many people will do that mistake. So institute is giving you. If you want, do it. Institute is helping you do mistake. So be careful. Just because they have given, you should not use it. That's why they said you may use. You need not use. Just because, I mean, if you don't read the word may properly, your November may become May or your may become November. Anyway, so we got the number. Concept I told you to remember shortcut. Last two cash flows will have same discounting factor, be it bond valuation or equity valuation. Easy concept to remember. Let's multiply and do the total. 1.68 into 0.86, 1.44. 1.88 into 0.74, 1.39, 2.07 into 0.64, 1.32, 0.28 into 0.55, 1.25, 30.78 into 0.55, 16.9. Total. $22.33. Some more less decimals, approximately 22 rupees. That's fine. That is value per share, present value. Some people call it as intrinsic value. Okay, hope you're done. Okay, let's go further. Come to this problem. You are interested in buying some stocks of RK Limited. That problem? Okay. You're interested in buying some equity stocks of RK Limited. The company has three divisions operating in different industries. Division A captures 10% of its industry sales, which is forecasted to be 50 crore for the industry. Division B and C captures 30% and 2% of the respective industry sales, which are expected to be 20 crore and 8.5 crore respectively. Division A traditionally had a 5% net margin, whereas Division B and C had 8% and 10% margin respectively. RK Limited has 3 lakh shares of equity stock outstanding which sell at rupees 250. The company has not paid dividend since it started business 10 years ago. However, from the market sources, you come to know that RK Limited will start paying dividend in 3 years' time. So, 3 years after that, 3 years onwards. And payout ratio is 30%. Expecting this dividend, you would like to hold the stock for 5 years. By analyzing the past financial statements, you determined RK Limited's required rate of return is 18%, P ratio is 10 for the next year, and on ending P ratio of 20 at the end of fifth year are appropriate. Required. Would you purchase RK Limited's equity at the time based on 1 year forecast? If your expected earnings to grow 15% continuously, how much will you be willing to pay for the stock of RK Limited? Ignore taxation. PV factors are given below. I think PV factors are there in the material, not be here. Is there in the material. Just read the problem once more. Okay. Let's read the first one. Would you purchase RK Limited's equity at this time based on 1 year forecast? Okay. Now, look at the paragraph. By analyzing the financial statements, you have determined RK limit required 18%, P ratio 10 for the next year. And they said based on 1 year forecast. So you have expected P ratio for next year, meaning at the end of 1 year. And the problem also said on 1 year forecast. Now, can you tell me what do you think we should compute now? We need to compute equity share price, value of share. For that, they said 1 year P ratio they have given and also told you use 1 year forecast. Now, can you tell me what we need to compute to be able to arrive at market price per share? Yes, We have P ratio. So how do you compute expected market price per share? EPS multiplied by P ratio. I told you P ratio based on the past analysis. EPS projected forecasted EPS, thereby we get expected market price today. P ratio given 10. So if you compute EPS, we will be able to compute the expected market price. Hope you're able to think logically. Why should we compute EPS? Anyway, let's go further on this matter. Now, to compute EPS, we require profit after tax divided by number of shares. Ignore taxation. So after tax not required. A simple profit is sufficient. Number of shares do we have? Yes, we have 3 lakh number of shares. Then what else we require? Income of the company. For income of the company, they said company has 3 divisions, and division A, division B, division C. Regarding the 3 divisions, they said how much is their market share. For example, division A has got 50 crore for the industry, and 10% is the company share, this division shares. So 50 crore, 10% is 5 crore. So 5 crore is the turnover of division A, sales of division A. But we require income. No problem. They said 5% net income margin. So 50 crores industry share, industry worth multiplied by 10%, that is your industry share, your company share. So 15 to 10%, 5 crore is the turnover of your company in the industry, turnover sales 5 crores, and that you multiplied by the net margin will give you the net profit. Like this we do for division A, for division B, for division C. We get the net income of individual division, total it. We get total income of the company divided by number of shares. We get EPS multiplied by P ratio. We get the projected market price value according to us. Let's compare with the actual stock price, market price. If stock price is less, good, let's recommend to purchase. Otherwise, let's recommend it not to purchase. Let's follow that approach. So margin for division A, 50 crore into 10% into 5%. 50 crore is industry worth, industry volume, industry sales. 10% is your company sales. 5% is the net margin. So 25 lakh is the profit from division A. Similarly, from division B, division C, you please write down. Hope you're able to calculate. Please do it. Okay, hope you're able to get the numbers. So total profit income of the company 74 lakh 70,000. There is no tax part. Divide by number of shares, you get EPS multiplied by P ratio, give you the expected market price. Tell me how much expected market price you get. You get 249. 24.9 into 10, 249. Now please tell me, this 249, is it today or after year 1? When is it being computed? This is after year 1, forecasting at the end of year 1, P ratio at the end of year 1. So this market price also expected price after year 1. Now, but we require today value. What we should do? What do you think? We need the value today, but this is the price after year 1. So what to be done? We just need to apply first year discounting factor, divide by 1 plus R, discounting factor for first year. So discounting factor for first year 0.847 given in the problem into 249 to get 10.9. This is the value based on projections. But what is the market price today given in the problem? 250. Price is high. When the price is high, we usually don't recommend to buy. So overpriced, so not recommended for investment purpose at this price. Please write down. Okay. Uh, this is the first part of the question. Let's go further. What else they've asked? If your earnings, if you expect earnings to grow 15% continuously, how much are you willing to pay for the stock of R Limited? Meaning, we'll have to apply the dividend discount model here continuously, forever, perpetually. Earnings will grow and dividend will be paid. I can point it out and tell you, but before that, you tell me in this problem, uh, what is their dividend policy? When do they pay dividend? How much do they pay dividend? Are you able to see in the question where that information is there? When do they pay dividend? How much do they pay dividend? When and how much? The company will start paying dividend from year 3 onwards. Only year 3 onwards. And payout ratio is 30%. 30% means what? 30% of earnings. That's why they said earnings will grow continuously. And we already calculate EPS also. Let's make use of all this information. Let's calculate. So here 1, 2, 3, 4, 5, 6 onwards. Okay, one second. Okay, so company will pay 3-year dividend 3 year onwards, and your holding period expected in this dividend, you would like to hold the stock for 5 years. And by analyzing the past financial statements, you have determined this. Okay, so since your holding is still 5 years, your holding period, I will compute at this point in time. So we can say how much will be the price after different points in time, because your holding period is 5, but dividend will be paid only from year 3 onwards, meaning first year, second year and all, no dividends. So year 1, 2, 3, 4, 5, 6 onwards, cash flows first year D1, D2, D3, D4, D5 onwards. Now cash flows first D1, D2, 0, 0, as you rightly pointed out. D3 onwards, you will have 30% growth rate. Please write down till here. I'll explain that further. Cash flows up to second year, 0 growth rate. I mean, no dividend, not growth, no dividend. Then your holding period is till 5th year. So I've written up to that point, what is the price, and 6th year onwards for the price after that. Okay. Now 30% is the payout ratio of the earnings, correct? So 30% is the earnings. Now what is going to be your earnings after 3 years? Now EPS I can't use directly as on date, because EPS is what we computed today. What is the EPS we computed today in the previous part of the question? EPS we computed as 24.9, right? 24.9. But this EPS I can't make use of it. This EPS cannot be used because we need at the end of third year onwards. Because dividend is paid only from the end of third year onwards. But this EPS is at the end of first year. Now first year to third year, the EPS will grow. Earnings will grow. At what rate? Earnings will grow at 15%. That's what I did here. 24.9 is at the end of year 1. We need at the end of year 3. So 1 plus R compounded grown at 2 times 15%. So 1 plus 0.15 whole square. So this 24.9 is at the end of year 1. Year 1 EPS 24.9 into 1.15 square is the EPS at the end of year 3. Then 30% you get 9.88 dividend you get. Similarly, then that point onwards you can simply grow by 1.15% continuously, no issues. So 9.88 into 1.15, you get 11.36 into 1.15, 13.06. Then you know the formula, G phi into 1 plus G by K minus G. And again I repeat, why are we doing D6 onwards? Because your holding period is 5th year end. At the end of 5th year, you will sell it off. So I'm showing you at that point onwards. Okay, then discounting factor 18% multiply. And remember, last two cash flows will have same discounting factor. Please multiply and tell me how much amount you get. Why no payout ratio in year 4? You can do, but same thing will apply. No, dividend also will grow, earnings also will grow. So you can compute the earnings EPS. Then on that you can do 30%, which will be same as 9.88 into 1 plus R. Because from that year onwards, dividend also will grow, earning also will grow. So you don't have to worry about it. You can calculate it. Effectively 30% payout ratio only will happen. Even if you calculate, you can verify. You can do like this: 24.9 into 1.15 cube, 3 years happened, into 30%. You can check, it will be 11.36 only. Okay, hope you got it. Multiply discounting factor given the problem, so simply multiply. Present value is 236. So if your holding period is 5 years, today you will be willing to pay 236. Is that what they've asked? The question, how much are you willing to pay for stock of RK Limited? So you will be willing to pay maximum of 236.36 for stock of RK Limited when holding period expected 5 years. Okay. In fact, you don't have to come to till year 6, because anyway 15% forever. So even if you stopped at year 3, also you could have got the same answer. I'll just show you for your reference. If you stopped at year 3 only, what you would have done? Had you done like this, year 1, year 2, year 3 onwards, what would have happened? Cash flow 0, 0. This is here only you would have done D3 onwards. So D3 by K minus G. So 9.88 D3 by K minus G, 0.18 minus 0.15. Please tell me how much you get. Counting factor 0.847, 0.718. This also will be 0.718. How much you get? 9.88 by 0.03, I think. 9.88 divided by 0.0, not 0.03, 0.18 minus 0.15. Sorry, 0.15, not 0.015. 0.15. 9.88 by 0.03. You get 329. 329. Okay. So discounted cash flow you do. This is anyway 0. This is anyway 0. 329 into 0.718. You get 236. Approximately you get. Same number you get. Intrinsic value P0. The reason why I did till 6th year, because in case in the problem they said person want to sell after 5th year, what is P5? That would be 218. Only for that purpose I calculated. But otherwise, because anyway cash flow dividend is getting stabilized, earnings is growing continuously from year 3 onwards only. So year 3 onwards only we can stop it. We don't go beyond that. This much is also sufficient. Only for reference, because the holding period is 5 years, I showed you till 6th year onwards. But in exam, you can even do this. That is also sufficient. Okay. Hope you got it. Shall we go further? Come to this problem. Come to this problem. The beta coefficient of Target Limited is 1.4. The company has been maintaining a growth rate of 8% in dividend earnings. Last dividend was 4 per share. Return on government security is 10%. Return on market portfolio 15%. Current market price of one share is 36. What will be the equilibrium price of Target Limited? Would you advise purchasing the share? So this is also we do using Gordon models only. But only thing is, cost of equity they have not given directly. Now cost of equity, we solve it using CAPM, capital asset pricing model. Some of you would have learnt already in intermediate level also. But anyway, in detail regarding CAPM, we have it in portfolio management. How to compute, what is the logic, what are the derivations of CAPM. As of now, I'll give you the formula. Just take the formula, that is sufficient. RF plus RM minus RF into beta. RF risk free rate, beta B, RM is market rate of return. They have given government securities. Government securities take it as risk free rate. Government is always the lowest risk, no risk, 10%. Plus RM minus RF, market portfolio 15%, minus RF 10% into beta. Beta also they have given, which is 1.4. So 10 plus 5 into 9, 1.4 is 9. So 10 plus 9 becomes 19. Oh, sorry. 7, no? 7, okay, 7, 7. 7, 70. Get 70. Okay. Now using equilibrium price, different name they give. Equilibrium price means intrinsic value only, value per share only. So P0, value, equilibrium price, value. D1, okay, they have given dividend last paid. So I'll use D0 into 1 plus G by K minus G. D0, last paid 4 rupees. Growth rate, earning growth at 8% plus 0.08 divided by KE, we calculated 70%, 0.17 minus growth rate 0.08. So see how much you get. 48. Okay, 48. And what is the price? Actual price is trading at actual price trading at 36. So would you advise purchasing the share since the price is less? Price is less. So it is recommended, advised to purchase, recommended to buy, recommended to purchase. Okay. So that's all, simple one. Let's go further. Come to this problem. Come to this problem. Following the financial data of Platinum Limited are available for the year 2011. Equity share, debenture, bonds, reserves and surplus, total assets, asset turnover ratio, effective tax rate, operating margin, required rate of return, dividend payout ratio, uh, current market price per share. You are required to draw income statement for the year, calculate sustainable growth rate, compute the fair price of the company share using dividend discount model, and draw your opinion on investment on the company share at current price. Okay, so what they have given, we have to create a income statement. We'll start from sales. Regarding sales, what information is available? Asset turnover ratio 1.1. What do you mean by asset turnover ratio 1.1? If you have an asset of 1 rupee, you'll be able to make a sales of 1.1 rupee. Do you have the information assets? Yes. Total assets 500. Total assets 500. Turnover ratio 1.1. So assets into asset turnover ratio 500 into 1.1. You'll be able to make a sales of 550 lakhs. Write down. Okay. Turnover, we got it. The income statement, sales, we can write it comfortably. Operating expenses, we don't know yet. Operating expenses, we don't know yet. But EBIT, they said 10% of turnover. Have they given? Let's see what they've given regarding the earnings per share. Operating margin 10%. What is operating margin? Obviously calculate based on EBIT only. EBIT by sales. So 10% on sales. So 10% on 550, that is 55, operating margin 10%. was operating margin. Okay. Interest expense we can easily calculate. 8% debenture, 8% on 125, 10% bond, 10% on 50. That is a interest elements. Bond 15 to 10%, debenture 125 to 8%, 5 and 10, 15. So you get EBT of 40. Tax rate is also given 30%. You get profit after tax. So we have done the income statement. Okay. So PAT we got it. Let's see if any other information is there. Okay, dividend payout ratio is there. Okay, let's do payout ratio also 20%. Payout ratio 20%. So you get retained earnings. Surplus transferred. You can say retained earnings. And operating expense you can do as a balancing figure if you want, because anyway we know EBIT, we know sales, fixed expense, variable expense breakup we don't know, but sum of it we know, that is balancing figure. So this amount is a balancing figure. Okay, hope it is done till here. Let's see what is required in the problem. Calculate sustainable growth rate. Sustainable growth means growth rate. Remember the formula growth rate. G equals B into R. Retention ratio into return on investment. Retention ratio, we know payout ratio 20% means retention ratio should be remaining 80%. But what about return on investment? That is not there in the problem, not given directly. Let's calculate return on investment or return on assets, return on equity, whatever you call it. Return means PAT. We know we have already calculated PAT. We have information on the asset side and all. Let's calculate. Then multiplied by the retention ratio, we get growth rate. Retention ratio 1 minus payout ratio. Retention ratio is payout ratio is 20%. So 1 minus 0.2, you get 0.8. Calculate the, write down that first. Okay. Let's come to return on assets. So return on equity will follow. That is the what is the return which is given by the company to its shareholders. PAT, which we calculated, 28, or you can do per share base also. Both way it's fine. PAT is 28. Net worth will calculate, or book value per share also we can calculate. Both ways do. PAT is 28 we are using. Net worth, reserves and capital, reserves and surplus 200, and equity shares at each capital 100. So net worth equity 100 plus 200 300. You can do per share basis or you can do total basis. I am doing total basis. Total PAT, profit after tax 28. This is share capital plus reserves and surplus. That is your net worth. Return on equity 9.33%. Retention ratio 0.8 multiplied by return on equity 9.33. That's what you get. The growth rate of 0.0747 or 7.47%. Please write down till here. The book is it 14.36? Are you sure? Which book? I don't know. Your material. Which question? Hope you are in the same problem. Please don't compare some other problem with this problem. Okay. So we got the sustainable growth rates. Next, compute the fair price of the company share using dividend discount model. So that we know dividend discount model D1 by K minus G. D1 dividend. How much is dividend? Total payment is 5.6. If I go for per share basis, 5.6 by 10 lakhs, 0.56 per share basis into 1 plus G, growth rate 7.47 divided by K minus G. K we don't know the answer, so we'll assume the return on investment itself as this itself as KE because we don't have any cost of capital information. So we assume return on equity itself is KE. So that will give you 0.79, 7.99 or 8 rupees. So value is 8 rupees, but in the market, current market price 13 rupees. So we can just say that it is overpriced in the market. Overpriced in market. When they say 6 year onwards and calculate terminal value, does it extend up to nth year? Of course, when we use dividend Gordon model, it means it's infinite years. 6th year onwards forever, discounted till 5th year, then we discount it further to present value. Gordon model means that the dividend is considered for n number of years. Dividend is considered for n number of years. Okay. So I hope you have done till here. Terminal value can be any year, correct? But I'm not sure what you're asking. Terminal value can be any year, yes. Terminal can be 5th year, but that is the present value of future cash flows. Terminal value is the present value from that point onwards, and then we discount it further. So ultimately we get today value. Okay. So hope everybody able to got this one.